Welcome back to the evening before a critical CPI release. In this video, we're going to chat live, yes, albeit on the main channel, about what to expect for tomorrow. Specifically, not only expectations, but what to look for. The most important thing to look for is something that we haven't actually been talking about that much. It has to do with Jerome Powell's discussion that the first part of inflation coming down might be the easiest. That is goods-based deflation and lapping higher year comps. It's easier to have lower inflation or the rate of increase. It's easier for it to feel like that rate of increase is lower when we're comparing to high rates of increases in 2022, like the 9% that we had in the summer of 2022 when inflation peaked out. It's easier to compare back to those higher numbers and see inflation falling, especially when goods inflation is driving, or goods disinflation is driving a lot of that declining inflation. The question is, will tomorrow we finally start seeing more goods and services deflation together? Specifically, of course, services deflation. This is the big deal. Now, there is a belief that yes, indeed, it's possible. I mean, look at the last CPI report that we have. The last CPI report suggested that airline fares had fallen 13.2% year over year. That's right here, the year over year column, 13.2%, and that they had fallen 0.9% in just a month over month period. This is also where we got that CPI data that health insurance was at least feeling to some folks potentially rigged. When we looked at health insurance, we saw health insurance decline 34% on a year-over-year basis. Now, of course, that health insurance segment did have a footnote at the bottom suggesting that the calculations for determining the cost for health insurance had been changed. And therefore, in the seasonally adjusted data, you should see much smoother information. But in the non-seasonally adjusted data, which is that left number, you would expect to see a larger number. This was explained by the Bureau of Labor Statistics, though, of course, the only thing that people threw up on Twitter was the following. Oh my gosh, health insurance down 34%. My health insurance isn't down 34%. Must be rigged. Well, that's how you lose nuance in economic analysis, and that's how people end up getting caught flat-footed when it comes to economic data. And this is why, with the research we do every single day, not just on the channel, but also in the course member live streams, and what we do with our team, when we said last December, hey, we might be in the chips recession now, and if we're in the chips earnings recession now, maybe now's the time to buy, and we see a volatile Nike swoosh ahead, why that ended up being the right move. The question is it time to rebalance to another sector? Well, in my opinion, this is probably still likely to be the most resilient, at least in the near to medium term. That is, the chips and pricing power stocks in price declining environments. Now, that's going to be a little bit more challenging to try to evaluate. How do you find stocks that actually have pricing power in an environment where everything is deflating? Well, usually the pricing power style stocks, at least the definition that we use in our prospectuses for our ETF, is the definition that even as prices fall, a company with pricing power is one that reduces prices less than the competition and or sees increasing margin relative to the competition. So, perfect example, you look at Tesla, the only profitable North American EV manufacturer, quite frankly, Western EV manufacturer, fully battery electric vehicle manufacturer that's profitable. That's Tesla. And so trying to find those companies that win in an environment where their margin can expand more than their competition is the challenge. Maybe another stock like that could actually be Lulu, though a lot of folks wonder, will Lulu continue its strength? After all, Macy's just got a buyout offer. There's a lot of talk about the lower income consumers having to stretch themselves with more credit card debt, delinquencies rising slightly above 2019 levels, and American Express saying the opposite. American Express being the company that caters to higher net worth individuals, specifically like those making more than six figures and with over a 700 credit score. American Express finding that their consumers are not actually paring back. In fact, that spending seems to be relatively flat amongst those higher income consumers. So what kind of stocks could potentially benefit in a near recession slowing economy where the higher income consumer is now comfortable that their stocks have bottomed out, that their assets have bottomed out, and that we're on the road to recovery. Well, again, in my opinion, those are the companies spending money on chips and manufacturing chips to support services for that, as well as individuals who are willing to spend via either American Express, Lulu, whether it's Tesla or Enphase or however, to invest. And so that's why I've been trying to cater my portfolio to that higher income demographic, expecting or at least hoping that they would fare better in this sort of deflationary recession that we could face, or near recession that we could face, since we might not actually go into recession. What I do think is very interesting here is this. If you look at inflation, this is Bloomberg, you find here, inflation is less damaging for stocks than deflation. I found this was very interesting. This is an article that's essentially arguing US stocks have coped better in a cycle that's seen inflation soar to highs since the 1980s. So in other words, as inflation rose, everybody thought every company had pricing power because everybody is able to raise prices. But that's not the definition of pricing power I use. I don't look for rising prices. I look for succeeding where nobody else is able to succeed through higher margins. That is a game changer. Enphase has that in the solar industry. Tesla has that in the vehicle industry, and so on. We already know this. Now, this is interesting. A serious downside surprise for inflation might actually be worse news for stocks than an upside surprise in inflation, even if the immediate response would likely be a fresh rally. In other words, they're saying here, if we get a weak inflation report, it's possible stocks could fall on earnings because all of a sudden it's harder to beat those earnings expectations because of deflating prices. Let's take a look at some of the expectations and some of the data we have. Expectations for tomorrow are that we have flat CPI month over month. On the core basis, though, looking to get to 0.3, which is slightly higher than that 0.2 for the previous report. CPI year over year expected to come in at 3.1% versus 3.2 prior, so a slight decline. There's that slowing Jerome Powell is talking about. In order for us to actually make Jerome Powell happy, like what would make Jerome Powell happy, what makes J Powell happy means rate cuts sooner, and what makes rate cuts come sooner makes people more enthusiastic about stocks. J Powell happy if this is under 3. I should say happier. So a J Powell happy, I think this comes in at 2.9, and you have J Powell very, very happy. I'd like to see that miss. As far as the core, it would also make J Powell very, very happy to see this J Powell happy at really probably something like 0.2 or lower. We don't really want that 0.3 read that's currently being estimated. That 0.3 read, not ideal. If we could get some more weakness in housing, maybe we'll see this come down. But we'll also be paying attention to Supercore. Supercore is going to be very important. So we'll be covering this obviously tomorrow live in the public live stream. Make sure you're a part of that. We're going to be on the Meet Kevin live channel with that. After this live stream, there'll be a redirect to that channel, so that way you can get direct access to that and you can make sure you have notifications on. But we'll be covering that live, and it's going to be a big deal. So that's going to be what makes J Powell happy. But what other information do we know? Well, first, I'd like to throw in, what do I think? What is my opinion of what's going to happen? I actually think we're going to, so I'm going to write down Kevin's opinion. So let's write down Kevin's opinion here. And I'm going to go for 3. I don't think we're going to get that euphoria of a 2.9 here. I would really like to see something between 2.4 to 2.6. Unfortunately, a 2.6 is going to get rounded up. A 2.4 is going to get rounded down. But I'd like to see a midpoint read here. I actually think a midpoint read would be good. But so I'm just going to make a decision here. I'm actually going to go with 2.4. I'd like to see a little closer to that 3, but I want to get that round down to 2. I actually think there's a chance. Well, so this would actually look like, let's write this correctly, 0.24%. And then I actually think this top line, we might get that minus 0.1%. And that's really going to set off enthusiasm that the deflation that countries like China and Germany are seeing will come here as well. Now, we'll see. Could end up eating my words, could end up being wrong about this, but these are my inflation expectations tomorrow. Now, what we can also do is we can compare my inflation expectations to what Wall Street's expectations are. Nick T put up a fantastic consolidation of what inflation expectations are for tomorrow. As you can see here, I'm pretty much only with Piper Sandler on this one. It seems like most of the other analysts are above my expectations. I'll zoom out for a moment or remove myself for a moment. Take a look at this. You've got here on the core CPI, remember I'm at 0.24. I'm only close to Piper Sandler, but everybody thinks it's going to come in pretty close to 0.3. So it would be one heck of a surprise to see that come in soft. Headline coming in at 3.0. That sounds relatively reasonable. Seeing these numbers, nobody over here negative on this headline. So I'm a little bit of an outlier. And this is based on our research and my thinking in terms of what's going on with actual earnings calls and the posturing that I'm seeing. And so this is my opinion rather than potentially the analysis of these individual analysts. I have my own opinion. Now, of course, another thing that I personally like looking at is I like looking at the multivariate core trend. And I think this is going to be very important. This will obviously get updated when we get PCE at the end of the month, but it'll be heavily influenced by the CPI report. And so if I go ahead and pull out everything except services X housing, which will be a big part of our super core inflation read that we'll get tomorrow, we're probably looking here at a declining set of inflation and a line that actually goes down even if we end up getting a 0.3% read on that inflation number. And that's because, as you can see here, the trend here is clearly down for the services X housing. This is a trend line, though, so it is not a point in time. And what we expect is, as you can see here, we actually had a multivariate core was 2.6% in October, which is roughly closer to that 2% we want to get to. That line, by the way, is this blue line here, which if we look over here, we can see that trend relative to the services X housing is roughly in the same pattern. And this is what we want to see continue. And if we can get a number under that 0.3 handle today or tomorrow, we should see this continue to trend down. Honestly, even if we get 0.3, it should continue to trend down. So I'm optimistic about this, and I'm excited to see inflation roll over. I actually think inflation will roll over a little bit faster than expected. However, I don't want to speculate that it will or will with certainty. We're obviously watching also Treasury yields move here. If I'm wrong and the numbers come in at expectations, we shouldn't see much of a move in the Treasury market. If I'm right, 10-year Treasury yields will probably fall under 4% tomorrow, which will probably lead to some kind of enthusiastic rally in not just the stock market, but also real estate. The real estate market is oddly sensitive to what's happening in the news cycle. People don't think that's true, but they're also not in the real estate market every single day like I am. We're writing offers every single day. We're getting offers accepted. We are making deals happen on a daily basis with HouseHack, and it's really exciting. What are the odds that we see a surprise? Well, most of the analysts, as you can see in this report right here, suggest no surprise. So, if you threw me on this list of analysts, you'd probably be at a surprise chance of 2 out of 14, so probably on the low side. Then what we'll go ahead and do is consider this Bitcoin volatility. There is some belief that maybe the crypto enthusiasts know that CPI is going to come in hot, and that maybe that's why Bitcoin is secretly acting a little bit more volatile, because after all, declining inflation is good for risk assets, which obviously Bitcoin is a risk asset. So let's take a look at some of the other data that we have as well. Moving away from some of these trends, I do want to see some of the bull targets that we have right here for the market, as well as bear considerations. Obviously, bear considerations are really higher for longer. This morning on the Market Open live stream, which of course will be live tomorrow morning at probably around 5:15 a.m., a little earlier. Here, bear market thesis is that we're not going to see rate cuts until Q3 of 2024, and if and when they would be very recessionary. Here you actually have Yardini suggesting the S&P 500 could make it to 6,000 in 2025. We're at 46.2 right now. So just to divide that out so you understand what that actually sounds like, that would look like a 30% stock market rally over the next 2 years. A roaring 2020 scenario, they suggest. And another analyst here interviewed by Bloomberg Surveillance, who is also from Yardeni Research. However, in her interview, she suggests that the reason for their bullishness is that most of the earnings recession is already behind us. Very interesting. The earnings recession being behind us. I agree with that. I actually think we've been through rolling recessions. We had the freight recession. We had the chips recession. We had the consumer cyclicals recession. We had the consumer discretionaries recession. And we're kind of rolling through the various different aspects of a recession. And the economy is actually holding up surprisingly well, as well as the fact that just like we discussed on the Meet Kevin podcast we just filmed moments ago, which I encourage you to watch, great content with Mikey, something to consider is that the United States is very sensitive to a recession when it comes to unemployment. This is actually a very big danger for the Federal Reserve, that if they over-tighten and we start creating a spiral of unemployment, we will unnecessarily so create a substantial recession that is vastly unnecessary. Despite this, though, the bond market is still convinced that we will face a recession, given that the bond market still indicates we are at an inverted yield curve level of negative 48 basis points. Very interesting. Take a look at this. Apple is making deals every day in the tech sector. Doesn't mean it is good space for the. That's interesting. So potentially talk about inflation or disinflation over at Apple and making some discounted opportunities. I hear that as well with Apple sort of for business, that they're willing to cut deals for businesses and otherwise. But that's not terribly uncommon. A lot of institutions are willing to do that. If you look at the market's expectation of inflation, you can see the market expectation of inflation is relatively benign. Over the last 12 months, the expectation is right here. I'll hide myself for a moment. Yeah, we could see if we just take the tip of where we are right now, just the tip, we are at the third lowest point in inflation expectations for the next 5 years. Of course, this number is very volatile and can change dramatically if we get a bad inflation reading tomorrow. I do want to give a little bit of an example, though, of what's happening with CPI in China. And I think this is a foreshadowing of what is to come in America. And that is CPI coming in at negative 0.2% year over year, and PPI, producer price inflation, coming in at negative 2.8%. I expect these sort of disinflationary numbers to happen in America as well. Just to be very clear, sorry, I misread this. The left number right here is the survey. This was the expectation. This was reality. So inflation actually came in substantially lower than expected. It's one of the reasons I have a thesis that we might actually miss on inflation as well to the downside. I want to be clear that the expectation was that we would have inflation of negative 0.2% in China. I'm going to show you by how many standard deviations, basically, inflation actually came in. Or I'll just simplify it. I'll just show you a chart that'll show you how bad that miss was on CPI year over year in China. And I think it's going to set up for potentially what we could find in America as well. Now, keep in mind, I always want to be very transparent because my goal is just to provide you perspective. I'm going to throw this chart up here on screen, but I want to be transparent with you. Obviously, I'm long the stock market. I believe disinflation is here. I've been believing that for over a year now. It has proven very successful in the first half of the year. We hit a lot of bumps in the summer, but I don't think the thesis has changed. So I'm not willing to trade or flip flop. I know people are, convinced or sort of have branded, at least some people have branded me under this idea of being a flip flopper. I think I've been pretty steadfast in this belief for a very, very long period of time. And if it's not tomorrow, it will probably happen within the next quarter. So within the next 3 months would be then, in that case, the first quarter of releases in 2024. It's kind of wild to think that we're already going into 2024. But I will not be surprised to see these sorts of misses in America as well. Take a look at this. This right here shows you what the forecast was. This is the forecast bell curve right here. And this is what we got in China. I think we are setting up for this kind of reaction in America as well. I don't know if that'll be tomorrow, it'll be next month. I believe it'll be within the next 3 months. We are going to see sudden misses to the substantial downside. Analysts are going to go, holy smokes, we're caught off guard. And I think there could be a very quick and rapid unwinding of funds that are sitting in money markets, interested in moving over to catch the stock market rally. which will also be good for Bitcoin. I'm not here to bag on Bitcoin. I love the underlying blockchain technology, and so I'm a big fan. Obviously, speculation is rampant everywhere, though. Speculation is rampant in penny stocks, in meme stocks, in various different coins and tokens. There's always, and even in real estate, I see speculation happening right now in real estate. There are people taking out hard money loans, and this scares me deathly. There are people taking out hard money loans that are 15% interest only, 2 points, 3 points, 4 points, 5 points. That's, percent payment up front. Due and payable in 6 months. Well, somebody buys a flip now thinking that, oh, well, rates will come down in March, therefore prices will go higher. But then inventory is higher in March. You're screwed. Screwed. So, and then that could actually end up being a very glorious opportunity for HouseHack. I do want to just provide a very quick opportunity to remind you that we do have a HouseHack YouTube channel. I suspect that by tomorrow we're going to have a nice HouseHack video update ready to go. I did actually post a video update, a sort of tweet, a comment, which I actually should have reposted because not that many people are aware of the Twitter account yet. But HouseHack does have the Twitter handle HouseHack Homes. I just retweeted it. But anyway, quick update there on that. Share certs for Reg A are expected to come out Q1. Our first half of 2023 financials are due in 3 days. So we have external auditors reviewing those. That's sort of the way Reg A's work is you're a little bit behind, but they're semi-annual financials. Obviously, we look forward to going to quarterly in the long term. Second HouseHack property has been rented. We've got the one-to-one fundraising is done. There should not be any one-to-one fundraising again, with the exception of individuals who have warrants, should we decide to call those. Our financials again due in 3 days here. We've got 5 more properties under construction, 6 to 8 more in escrow, depending on probate approvals. Mini fund plans are solidifying. That's very important for HouseHack's phase 2. And then, of course, I'm training on a daily basis our teams to make sure we can operate the company very efficiently. Just to give you an example of my schedule today, and then we'll get back to some of the news here. This morning, I didn't get to sleep until about midnight. And today, it's really started to hit me. Like, I feel like I need to get a little bit more sleep today because I feel a little pooped physically. Really, I hit about 4 hours of sleep today, and I was up until midnight working some rental applications, and then which I'm also training somebody else to take over, which will be great. Once I got the first phase trained, it'll be a lot easier. But it's so important to be involved in the first phase, so we're not building good foundations, or should I say bad foundations on top of bad foundations. We want to build good foundations on top of really good foundations, right? But anyway, then this morning, obviously up early to be ready for the stock market open live stream at 5:25, which we do every single day the market is open. Course member live stream at 6:45 thereafter. I was at the airport at 7:45 filming a HouseHack update. We flew, visited 3 different cities today, multiple different properties, and I was able to be back here home by about 3:45 p.m., which is not bad for having an hour flight commute, each way. And then we were back and did our podcast, and then here we are doing this update live right now to prep for CPI tomorrow. And then, of course, after this, I'll be going back to work for HouseHack. So it is a lot, but that is the nature of entrepreneurship, right? This is what I've agreed to and signed up to, and I actually love it. It provides me a lot of enthusiasm and happiness, and I make sure to spend a lot of time with my family on weekends, usually by taking them to look at houses for HouseHack, which is fine because then we can still hang out afterwards and go to dinner or whatever. So anyway, that just kind of gives you a little personal update. But I'm very excited because honestly, I feel like me launching my ETF was the bottom of the stock market. I feel like the sort of hair reset was a little bit of like a personal, like, okay, now it's the time to get really serious. And I think we're paving really good foundations here. So very excited. And we're doing an incredible amount of winning in HouseHack. It's almost overwhelming, the amount of winning that we're doing. So we're gonna share a lot of that. I have one final test for my series licenses. I've got 7 tests in total that I'll have gone through. I make a joke. I didn't know the Series 7 was a series of 7 tests. But anyway, people in the industry will get that. Yeah, that'll be done hopefully this week. So I'm very excited. And so let's get back to covering a little bit of news. As far as Nick T, I did have another tweet from Nick T that I wanted to cover. And this had to do with trends as well. I'm a big fan of Nick T. I think he's well, not only I think does he get the cell phone text from the Federal Reserve, but I think he's also pretty intelligent. So I think he does a good job. And I'm happy for the work that he does. Inflation expectations watch. A year ahead inflation expectations declined to 3.4% last month in the New York Fed consumer survey. That is the lowest level in 2 years. 3-year ahead inflation expectations remain at the pre-pandemic level. So this is very interesting because last week we had the preliminary read for the University of Michigan Consumer Sentiment Survey, and consumer sentiment had actually skyrocketed. Not only had consumer sentiment skyrocketed, but we saw a plummet in inflation expectations. That's actually very, very good because I do believe that's going to translate to higher income individuals spending more money on higher income goods and services. So we'll see. American Express, Enphase, Tesla. Inflation expectations to watch. Let's take a look at this actual chart here. These are the median 1 and 3 year ahead inflation expectations. As you can see, the 3 year is roughly equivalent to about that 2018-19 period, with the exception of that inverted yield curve we had in 2019. And then we have the 1 year ahead inflation expectations, which have almost plummeted back to their 2014 lows. How wild is that? How wild is that? I find this very, very interesting. So it is good. One of the factors when we study history is we look back at 1984 and 1985. And one of the things that you're going to see in 1984 and 1985 is that the Federal Reserve began realizing that, oh my gosh, inflation expectations are starting to fall. Maybe we don't have to do as much as we thought. I think our Federal Reserve is trending in that direction. So I'm very excited about that. So with that said,
just close the fucking door. Close the door.
Yes. So with that said, I encourage you to click the redirect link to see me on the live stream for CPI live tomorrow morning. We'll be live at about 5:15 a.m. Thank you so much for watching this live stream. I appreciate y'all. Bedell Property Management says, somebody get this guy an app. Appreciate you, man. Always calling it like it is.